The information provided in this podcast is for general educational and informational purposes only and should not be construed as investment, tax, or legal advice. The views expressed are those of the host as of the date of this recording and are subject to change without notice. This podcast is not intended to provide specific financial recommendations or serve as a substitute for individualized financial advice. Any references to tax strategies are general in nature and may not be appropriate for all individuals. You should consult with a qualified tax professional regarding your specific situation. Investment advisory services are offered through an SEC registered investment advisor. Registration with the Securities and Exchange Commission does not imply a certain level of skill or training. Past performance is not indicative of future results. Investing involves risk, including the possibility of principal loss. This podcast does not constitute an offer to sell or a solicitation of an offer to buy any securities. Welcome to On Course Financial, Charting Your Financial Future. This is the podcast for people who want clarity and confidence in their financial decisions. I'm Chris Brumlow. I'm a partner with the BAB Group. I'm a financial professional and an investment advisor representative, as well as retirement planning specialist. The BAB Group is a proactive accounting and wealth management firm focusing on individuals and small business owners to provide holistic advice when it comes to navigating their financial futures. We help those individuals and business owners understand their numbers, connect them to real decisions, and use them to plan for the future, not just react to the past. In our podcast, this is where we talk about the real intersection of business, taxes, retirement, and life planning. Each week, we focus on helping small business owners and individuals make clearer, more confident financial decisions without hype and without the guesswork. Welcome back to On Course Financial, Charting Your Financial Future, the podcast where people want clarity and confidence in their financial decisions. Again, I'm Chris Brumlow, a financial professional, investment advisor representative, and a retirement planning specialist with the BAB Group. If you listened to our last episode, you already know that retirement planning without tax planning is incomplete. Today's conversation builds directly upon that idea because even with good tax planning, ignoring tax rate risk and ignoring how your money is taxed can undo years of smart savings. So what is tax rate risk? Tax rate risk is a simple in concept, but powerful in impact. It's the risk that future tax rates will be higher. Think about it. Retirements are lasting 10, 20, 30, even 40 years now. And the risk is that the future tax rates will be higher than the rates that you're paying today and the rates that you plan to pay. Notice I say risk. It's not certainty. No one knows exactly what future tax law will look like. Some might say it's written in pencil, but smart tax planning requires contingencies and not certainty. So why this risk exists in the first place? Well, we're living in a very different environment than past generations of retirees. First of all, people are living longer. That means retirements are lasting decades, and retirees want more flexibility and freedom than ever before. And at the same time, programs like Social Security and Medicare are supporting more and more people for longer and longer time, while the number of workers supporting those systems is shrinking. Add historically high federal debt and long-term funding pressures, and you get uncertainty around how future government revenue will be generated. None of this guarantees higher taxes, but it makes the possibility of higher taxes very real. And untested assumptions are dangerous in retirement planning. And consider this. As of 2025, 102% of every tax dollar that comes into the U.S. Treasury goes out to pay for only 7 things: Social Security, Medicare, Medicaid, interest on the national debt, income security programs, veteran benefits, and federal civilian and military retirement benefits. 102%. So in order to pay for everything else in the budget, the government has to borrow money. Everything else. Now, I don't know how many of you folks have heard of a gentleman named David Walker. David Walker was the Comptroller General of the federal government for 10 years under the Bush and Clinton administrations. He was the head of the Government Accountability Office and on the board of Social Security for 7 years. He was the nation's chief auditor. He was basically the CPA of the USA. He probably knows more about the fiscal condition of Social Security and Medicare than anyone else on the planet. And back in 2009, he said, quote, regardless of what politicians tell you, any accumulations of debt are absent dramatic reductions in the size and the role of the U.S. government, basically deferred tax increases. Unless we begin to get our fiscal house in order, there's simply no way to handle our ever-mounting debt burdens except by doubling taxes over time. Even if Congress does nothing, it's a decision with consequences. Doing nothing will either result in huge cuts to government programs down the road or a huge hike in taxes or some combination of the two. You know, one solution to the entitlement conundrum has always been circulated that we just could raise the taxes on the rich. That would solve all the problems. Here's the problem. Most of America's income is earned by the non-wealthy, like Scandinavia and most of Europe. The U.S. will need to tax families considerably to meet those ambitious revenue needs. Taxing the rich cannot even cover the baseline deficits, much less finance the current spending agendas. The Congressional Budget Office was asked to project how high taxes would have to go to pay for Social Security, Medicare, and Medicaid. The answer may shock you. They said if Social Security, Medicare, and Medicaid go unchanged, that the rate for the lowest tax bracket would increase from 10% to 25%. And the rate on incomes in the current 25 bracket, this was before the Tax Cuts and Job Act, would have to be increased to 63%. And the tax rate on the highest bracket would have to be raised from 35 to 88%. Now, one of the reasons that tax rates could be forced higher is the ever increasing cost of servicing the national debt. Let's take a look at how far we've come in the last 25 years alone. In the year 2000, our national debt was just $5.6 trillion. Yet the cost of servicing that debt was an astonishing $222 billion. By contrast, our national debt was $38 trillion by the end of 2025. And due to the surge in interest rate, the cost of servicing that debt exceeded $1 trillion per year. You know, there's a myth that tax planning is only for the wealthy, for the top 1%. That's not true. Most income earners in the United States are middle income households. They earn income through wages, retirement accounts, and Social Security, not complex offshore structures and investments. This means that changes in tax brackets, retirement rules, or benefits taxation primarily affect middle America. Tax rate risk is not a rich person problem. It's a retirement problem. Now, let's go back over the three buckets which we can store our wealth for retirement. And to understand tax rate risk, you need to understand where your money lives. In retirement planning, all the money falls into one of three buckets. Bucket one is the taxable accounts. Bucket two is tax-deferred accounts. And bucket three is tax-free or tax-advantaged accounts. Every retirement plan uses these buckets, whether it's intentional or by default. Now, let's talk about the first bucket, taxable accounts. They include things like brokerage accounts, savings, checking. There's no upfront tax deduction. You invest with after-tax dollars. Interest, dividends, and capital gains may be taxed along the way. Their advantage is flexibility. You can access the money at any time, and there are no R&Ds or required minimum distributions. And long-term capital gains may be taxed at favorable rates over ordinary income. But taxable accounts still add to your overall tax picture and can have the further challenge of having tax drag so that their growth and their increases over time are less effective than when we have tax deferrals. It also can affect your Social Security taxation and your Medicare premiums. Now, if we look at our second bucket, tax-deferred accounts, those are accounts which most Americans have their money stored in for retirement. They include traditional IRAs and 1Ks. You generally receive a tax deduction when you contribute. The money grows tax deferred, but every dollar you take out is taxed at ordinary income at whatever the tax rate is when you take that money out. And eventually, whether you need it or not, required minimum distributions are mandatory. This bucket creates tax risk later, especially if it becomes too large. Tax deferral is not tax elimination, it's tax postponement. Now, the third bucket, tax-free accounts, tax-advantaged accounts, are things like Roth IRAs, Roth 401ks, and some properly structured cash value life insurance. Contributions are made with after-tax dollars, but qualified withdrawals are generally tax-free. There are no RMDs for Roth IRAs over the owner's lifetime. This bucket provides for flexibility and control as well as legacy planning, especially in higher tax environments. Why the balance between these buckets matters. Here's the key insight. Two retirees can have the same net worth, but very different after-tax income. The difference is in the bucket balance. When all of your money is in the tax-deferred bucket, you lose control. When your money is spread intelligently across all three buckets, you gain options. Options to choose where your income comes from, options to manage taxes year by year, options to adapt if tax rules change. The goal is not to avoid taxes entirely. The goal is flexibility. Now let's cover some basic rules of Roth IRAs. A Roth IRA is funded with after-tax dollars. Earnings grow tax-free. Qualified withdrawals are tax-free if you're at least 59 and a half, and the money has been in the account for at least 5 years. But there's also income and contribution limits for direct Roth IRA contributions. So very powerful long-term tax. You can contribute $7,500 a year, and if you're over 50, you get an additional $1,100 in catch-up contribution. You can earn too much money, however, to contribute to a Roth IRA. There is also the requirement that you have earned income to be able to contribute to a Roth IRA. Now, the Roth 401ks are some employers are offering those. Like the Roth IRA, contributions are after tax. Ks are employer-sponsored programs and are being offered by more and more employers. What you do need to know about it, there are no income limitations on a Roth 401k. You can contribute up to the prescribed amount that is allowed for that year. There is a catch-up provision. Earnings grow tax-free. Withdrawals are tax-free if the rules are met. A Roth conversion moves money from a tax-deferred account into a Roth account. You pay the taxes on the amount converted, but future growth can be tax-free. Roth conversions are most powerful when they're done before your RMDs begin. And it's important to look at your income levels and your income buckets and do those conversions over time, because you pay taxes on the year that you do the conversion. So if you have a large balance, it might be a strategic importance to do that over a number of years. Here's the big takeaway from the day. Tax rate risk is real. The way your money is taxed matters just as much as to how it's invested. And the three bucket strategy is one of your important, powerful planning tools. Managing uncertainty in retirement means that you can be prepared for retirement. In future episodes, we'll dig deeper into retirement income sequencing and other aspects of planning for, entering into, and enjoying your retirement. I'm Chris Brumlow, and this is On Course Financial, a podcast to help you chart your financial future. Just a quick reminder, the information shared in these podcasts are for educational purposes only and isn't specific financial or tax advice. Everyone's situation is different. Good financial planning isn't about predicting the future. It's about creating flexibility. If today's episode raised some questions about your own situation, that's not a problem to avoid. It's an invitation to think more clearly. You can learn more or explore additional resources at our website, the BAB Group, at babcfo.com, or simply continue the conversation by tuning in next week. I appreciate you sharing, and we'll see you next time.